Welcome to video number 11 in my financial freedom video series. So today we're going to be talking about the terms you need for stocks, and then next time we'll be giving examples of some stocks, and then we'll get into my proprietary stock screen. So my name is Joel Solomon. I'm a prosperity coach, and my mission is to help at least 100,000 people become financially free. So they don't have to work if they don't want to. So let's talk about some terms you need to invest in stocks. First of all, you need assets. You need to know that each company has assets. They may have some cash and investments. They may have some property and equipment, some buildings. They may even have some intangibles. So if one company buys another company for more than it's worth in the stock market, say it's worth $1 billion, and Apple buys this company for $1.2 billion. An extra $200 million is known as goodwill, and Apple has to keep that on its balance sheet as a non-tangible asset or intangible. There's other assets as well. Don't really need to go into those in detail. And then there are liabilities. Liabilities are accounts that need to be paid in the future. Insurance companies have reserves for claims that either are going to be paid or have already been paid. They also have debt outstanding. And then there are companies that have pension benefits for their employees that have not yet been funded. All of these are considered liabilities. Now, the equity or shareholders' equity of a company is just the assets less the liabilities. Now we'll get into some terms that you need from the income statement. There are revenues. Revenues equal the sales of the company, how much products they've sold, plus their income from any investments they own. So revenues is sales plus income. Expenses is just their sales expenses, marketing expenses. For insurance companies, there's cost for those claims that they have paid, and there's also any increase in the reserves they had to take for those claims. And net income is just the operating income, and then adding in any one-time items such as gains on the sales of their stocks and bonds, or any other one-time gains or losses. There can be an impairment on an investment that they made that went down. So the net income is just revenues minus expenses. Now, cash flow is very similar, revenues minus expenses, but it's on a cash basis. So how much cash do you get from those revenues? How much cash did you have to pay out for those expenses? It's not exactly true that the income statement equals the cash flow statement, because sometimes the cash comes in, maybe you sold a product and the cash comes in a few weeks, but you recognize the sale right now. So cash flow from operation includes cash revenues less cash expenses, any income from investments, that is actually cash income, less any claims paid. And there's also cash flow from investing. Maybe you earned some money on those investments and you paid commissions to stockbrokers for investing. Overall, the net cash change is just the end of period cash less the beginning of period cash. So if it's the end of the year versus the beginning of the year, the change in the cash is your increase or decrease in the cash for that full year. Now, generally, there's a term that's used to approximate cash flow if you don't have the exact number. It's called the earnings before interest and taxes and depreciation and amortization, or EBITDA. I'll go over that. EBITDA is earnings before interest and taxes and depreciation and amortization. And so that number is really widely quoted, either EBIT, excluding depreciation and amortization, or EBITDA. And companies use that to approximate net cash flow. And we'll be using that shortly. So let me give you some other terms that we'll be using to calculate some ratios for stocks. So first of all, there's book value. The book value is really just the equity, the shareholders' equity talked about earlier, which is assets less the liabilities, divided by the amount of shares outstanding that the company issued. So, you own a share of stock. You own 1 divided by the total number of shares outstanding. Suppose there are 10 shares outstanding. You own 1 share. You own 10% of the company. E is earnings. It's the operating income we just talked about earlier, or net income, divided by the outstanding shares. EBITDA, again, is our approximation of net cash flow. And then we calculated book value just now. The price of the stock is what you always hear the company quoted as, the market price. So say Apple's at $100 and their book value is $20. Their price, 100, divided by their book value, 20, is 5. Now that's a very high number, and for insurance stocks, usually the price to book value is anywhere from less than 1, maybe 0.75 to around 2 times. Now the PE, or price to earnings ratio, is another common measure of the value of the company. The price of the stock divided by the earnings per share. Now we just calculated the E, where it was operating income or net income divided by the shares outstanding. So we have that number. PE is the market price divided by the earnings. And there's one other way to measure a stock, is by discounted cash flow. You may hear that term, DCF. So you're just taking the cash flows in the future and taking the present value of those cash flows. So if there was no interest rate earned on that cash, and the company earned, the cash flow was $1 a year for 10 years, then the discounted cash flow is 10. Now usually you can make more money by investing that dollar today, so the dollars in the future are worth less. So if you discount that dollar 10 years from now, it's not worth quite $1 today. So we usually discount it at a certain interest rate, and that $1 each year for the next 10 years would generally be worth less than 10. Let's say it's 7. But that would be another measure of a company's value. So let me stop there. There was a lot of terms. If you have any questions, please email me at joel@salamour.com. That's SALAURMOR.com. on any questions on any of these terms. Next time we'll be using these terms in comparing the stocks of 2 different companies. So I look forward to talking to you then. Thanks for watching. I believe in you.